On balance right now, the negatives of Trump 2.0 with tariffs are trumping the possible positive ones up ahead here. So I see a greater risk of a recession if he continues to persist with this tariff thing.
On WealthTrack, influential economist and strategist Ed Yardeni on the souring of the Trump trade.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategist Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. What a difference a new president can make. With remarkable speed, the pre-election and post-inauguration bullish Trump trade has turned into a bearish Trump trade trounce. Now, we don't do politics on WealthTrack. We have assiduously avoided the topic since our launch in 2005. We take the markets and investment climate as they are, and with the analysis and guidance of our financial thought leader guests, report accordingly. But the markets and the economy are telling us something major is happening. The change in sentiment and market direction are too big to ignore. So time to consult a highly respected veteran economist and strategist. He is Ed Yardeni, President and Chief Investment Strategist of his macro research and strategy firm Yardeni Research, which he launched in 2007. He is a PhD economist, longtime Fed watcher and investment strategist, and author of several books, including In Praise of Profits and Fed Watching for Fun and Profit. You can see our in-depth interviews with Yardeni about each book on wealthtrack.com. In 2019, Yardeni started talking about the roaring 2020s, where like the roaring 1920s, the economy and markets were advancing nicely. They still were at the time of our last interview in 2024. We asked him what has changed.
Well, we have a new president, clearly, with new policies. For the past many years, we've had radical regime change on a regular basis. And so here with Trump 2.0, clearly there's, initially anyways, a focus on tariffs, a focus on significantly cutting the federal payroll. And those are basically negatives for the economy and the stock market as well. So I would say that it still looks to me like the roaring 2020s. That's what I started talking about in 2019. There are similarities, obviously, with the 1920s and positive ones in terms of productivity, innovation, improving standard of living, people feeling better all in all. But people do remind me when I say, make an analogy to the 1920s, that decade ended badly with a depression following a great crash. That was the result of the Smoot-Hawley tariff that was passed in June of 1930. So, you know, there is another negative, deeply negative scenario here. We could have tariffs imposed by President Trump, presumably, possibly causing a tariff war, which then could depress global economic activity. So far, so good. The first half of the 2020s have gone quite well for this roaring 2020 scenario, but now's the challenge. I'm still hanging on to the roaring 2020s because I think there will be some compromises made on the tariff side. I don't think it's going to be Smoot-Hawley all over again. And I think the economy is resilient, and I think the stock market will still go up. I still have 10,000 for the S&P 500 by the end of the decade.
So there are those comparisons that are now being made that are much more widespread in the press.
Look, when he got elected, I wasn't the only one that thought that it would be a positive for the economy and the stock market. We all know that during Trump 1.0, he kind of viewed the stock market as a daily poll of how he's doing. And he kept bragging about the market going up, at least when it went up. On the days that it went up, he certainly bragged about it. So that seemed to matter to him a lot. This time around, he seems to be blowing it off and saying that he's not paying much attention to the stock market. He even called it the fake economy. And so that's been a remarkable change. But I think a lot of us were extrapolating Trump 1.0 into Trump 2.0. In his first term, He actually started out with tax cuts, which obviously stimulated the economy, and then he moved on to tariffs, and wasn't as aggressive on tariffs as he is this time. And this time he's starting with tariffs. It's going to take him a while to get a continuation of the tax cuts, and all it is a continuation, so it's not really going to change the underlying structure of the economy from that standpoint. Meanwhile, the risk is that he starts a trade war, and trade wars, is, we know from history, once they start, if you get a lot of retaliation and you don't get negotiations to bring tariffs down, they can obviously create a global economic recession, if not a depression.
So, Ed, why are you sticking with your S&P 10,000 and the roaring 2020s thesis?
Well, there's the
where's
short.
The optimism?
Well, there's obviously a focus on the short term as well as the long term. On a long-term basis, I still think that the economy is fundamentally strong. I think technological innovations are going to improve productivity. And over the years, I've learned that the U.S. economy has the ability to perform remarkably well despite Washington. The headlines are always focused on the Fed and on what the Treasury is doing, what the White House is doing, the fights between Treasury and Congress. The problem is we don't really give enough credit to the rest of us working stiffs that kind of go to work every single day and trying to figure out, given the background of what we need to deal with Washington, how do we succeed in that kind of environment? And we do that remarkably, remarkably well. So I'm kind of counting on the underlying resilience of the economy to continue to deliver a roaring 2020s sort of scenario. And it's very much based on technology-driven, productivity-led growth. And I think we've seen some of that in the first half of the decade. I think we'll see more of it in the second half of the decade. Then the short-term issues revolving around Trump 2.0. I'm realistic. I'm data-dependent. I like everybody else, I'm allowed to change my mind. And I initially thought that Trump 2.0 on balance would be positive, and it still could be, but the word is on balance right now. The negatives of Trump 2.0 with tariffs are trumping the possible positive ones up ahead here. So I see a greater risk of a recession if he continues to persist with this tariff thing. Initially, I think most of us thought, I certainly thought, that Trump's tariff bluster was all about negotiating deals. That the art of the deal meant that you bully the other side, you threaten them, and then you impose reciprocal tariffs, and then respond by saying, if you want to talk about it, we can talk about it. We saw that he's initially started out saying that he was going to impose 25% tariffs on Mexico and Canada, and then he held off on them for 30 days. And meanwhile, it actually worked in terms of getting the Mexicans to do more about the border issue. And it's been remarkable how that issue has been resolved. The problem is he also seems to believe that tariffs could bring in revenues, which means that they're not going to be temporary. And he also believes that tariffs are necessary to force companies to come back to the United States. So that's really what's changed in my mind, and I'm not the only one, as we can see with the markets. I mean, we reached an all-time record high in the S&P 500 on February 19th, and within a few weeks, the S&P 500 was in correction territory. It's bounced off of that recently. It could go back down. There's obviously a lot of volatility in the market, but the volatility has actually been straight down for the S&P 500. I started out the year thinking that the first half could be choppy because of the uncertainties of Trump 2.0 and how they would be implemented, but it's a lot choppier than I thought. It's certainly giving me vertigo. I'm going to have to get a neck brace, but I don't have to talk about all my personal ailments.
I think they're shared collectively, Ed, at this point.
Absolutely, yeah. That's my advice to everybody: get a neck brace.
Aside from the market reaction, where are the facts showing up of the impact that this whiplash is having on the economy, for instance?
Well, in addition to all the turmoil unleashed by Trump 2.0, we're trying to get a handle on how it all comes together. The data has been a mess for January and February. January was actually the coldest January since 1988, And February was also colder than average, and I think that depressed consumer spending during January. I think it also is why we had weaker than expected payroll employment numbers in both January and February. Retail sales were down in January. Personal consumption expenditures, which includes retail sales of goods and services, that was down in January. I'm expecting a pretty nice rebound in March and April data. In the spring there will be growth, and so I think we are going to see the economy show better strength on the consumer side. But meanwhile, the consumer sentiment indexes are actually going down, and I think clearly reflecting concerns about what's going on in Washington. Look, my wife a couple of weeks ago relayed that one of her best friend's son, who had been looking for a job for a long time, got a job at FEMA as a computer programmer. He's highly qualified, but now he's worried about his job. So I'm thinking, it's like 6 degrees of separation. There's probably, everybody in this country probably knows or heard about somebody losing a job in the government. And while, collectively, or at least half the country might agree that cutting back the payroll is a good idea, doing it this way with a shotgun is messy, and people aren't really happy with the way it's going. I mean, let the cabinet secretaries figure out who stays and who goes, and do it respectfully and slowly. Don't jam it all at the same time. And at the same time, people are very confused about what tariffs are all about. Look, if Trump simply at this point said, look, I closed the border in record time, and he basically said that in his State of the Union speech, and I also brought gasoline prices down. He can always take credit for things that he doesn't necessarily have much to do with, but there have been lots of factors bringing energy prices down. But arguably his promise to drill, baby, drill is keeping oil prices down. And he always said that the way that he'd bring prices down is by bringing gasoline and other energy prices down, because they drive so many other costs in our economy. So he could have taken credit for both of those developments and quietly let cabinet secretaries deal with their headcounts. But instead, he's really beating everybody up with tariffs. And people are totally confused about what that is. And I think the media's basically got it right that tariffs have the potential to create inflation, at least on a short-term basis. And people are scratching their head and saying, but that's not what the president promised in his campaign. He promised to bring prices down, and he was talking about tariffs, which could push prices up.
So I saw that in one of your recent reports that you actually mentioned the word stagflation. Slower economic growth and higher prices. So, what are the odds of that? I mean, and again, where are you seeing, dealing with the facts, where are you seeing signs of stagflation?
Well, I've been kind of laying out a couple of alternative scenarios. I don't like to just say, this is my base case, take it or leave it. My base case has a subjective probability, and basically a couple of weeks ago I was saying 20% probability for things really going wrong for all sorts of different reasons. For a while there before Trump, it was geopolitical concerns, possible debt crisis concerns, but now the main issue in that worrisome bucket or list of what could go wrong that has 20% probability certainly has to be the tariffs combined with a rapid cutback of payrolls at the federal government. The other 80% was that the stock market would go up. In one case, it would go up too much in a melt-up situation. In the other case, it would just be consistent with a roaring 2020s. Well, again, 2 weeks ago, early March, I raised the probability of a recession, of things going badly, from 20 to 35%, and that includes stagflation. Stagflation would clearly not be bullish for the stock market because it would mean slower growth, slower earnings, and persistently high inflation that would make it hard for the Fed to even consider lowering interest rates.
So speaking of the Fed, I mean, you are a noted Fed watcher. You've written a book about the Fed. So where do you think the Fed is as far as its policy is concerned?
I think at this point the Fed doesn't mind at all kind of lying low and keeping quiet. We really aren't seeing too many Fed heads out there speaking
Right.
over the past. They're really lying low. The best they can do at this point is do nothing, keeping the Fed funds rate where it is. Powell basically said the economy is in a good place. So I think they feel pretty comfortable leaving interest rates unchanged for a while here. The challenge will be if the economy actually does fall into recession because of consumers hunker down, they're confused, they don't like the way policies are going, and we get retaliation that creates global economic slowdown. Then what does the Fed do, especially if it's all because of tariffs, and tariffs, at least for a few months, lead to higher inflation? The Fed, I think, would be sort of off the hook because everybody will be blaming the fiscal and tariff policies of the administration rather than the Fed. But look, I think the economy is fundamentally resilient. It's sound. Past 3 years I've been arguing no recession.
You have been. You were one of the few, as a matter of fact, who was not calling for a recession after the Fed raised interest rates so dramatically. Yeah,
so look, I may be overstaying my welcome and optimism. I mean, just because the economy performed well over the past 3 years in the face of a significant tightening of monetary policy doesn't necessarily mean that it's going to remain resilient, but that's kind of the lesson I've taken away from the past 3 years is I thought the economy was resilient, everybody else didn't agree with that, and that turned out to be right. It was resilient. So I'm betting that the economy is going to be able to actually handle all this Trump turmoil 2.0, and that earnings will actually hang in there remarkably well. But again, I'm realistic here, and I think that this is having a negative impact on the stock market. And in addition to increasing the odds of a recession from 20% to 35%, which obviously doesn't mean that I think it's inevitable, I also trimmed down my bullish outlook for the S&P 500 from 7,000 at the end of the year to 6,400. Now that may seem like a pretty big slice, but I didn't change my earnings, which remain quite positive because I'm betting on the resilience of the economy. What I lowered is the valuation multiple. I figure that the turmoil caused by Trump is not good for valuation multiples. It creates too much uncertainty and confusion. And so I just lowered it from 22 to 20, and that's what I get in terms of my year-end forecast, 6,400 for the S&P 500. So it's still a bullish outlook. It's just less so, reflecting what I think is a realistic assessment of the risks that have occurred as a result of the new administration.
So what should we look for in the months ahead? What are you paying particular attention to as far as a market indicator and or an economy indicator?
For the economy, I obviously focus on the consumer. The consumer is the big gorilla in the economy. They keep the economy growing. One of the reasons that I thought the consumer would remain resilient over the past 3 years, when a lot of other people were saying, including Jamie Dimon, by the way, back in 2022, Jamie Dimon, the head of the JP Morgan, was saying that consumers look okay, but they're going to run out of their excess savings accumulated during the pandemic, and when they run out, that's when a big hurricane is going to happen. And he was wrong about that, and he had more information than I did, but I just actually he should have had more information because we're both baby boomers, and I see that all my friends are retiring, and the baby boomers are sitting on something like $80 trillion of net worth. It's the richest generation we've ever had. So they're spending a lot of money on healthcare. They're spending a lot of money on leisure and entertainment, restaurants. And by the way, this is where all the employment gains have been, and they've kept the economy going. Now my concern, and I've heard that a lot of senators and representatives, particularly of the Republican persuasion, are getting calls from their constituency, and people are saying, what the hell's going on here? I was feeling pretty good about my retirement assets, and now my stock portfolio is down 10-20%. And I don't understand why this is happening. The president didn't tell us he was going to give us a recession and a bear market. So I think there's a lot of pushback. So my concern there is that the people who've actually been spending a lot might actually hunker down if the stock market continues to worry them, and uncertainty about the economic policies continue to worry. So I'm watching the consumer very carefully, and I am looking for a solid rebound in retail sales in March and April. Now you might be wondering, well, given what I just said, why would there be a rebound in consumer spending? And the answer, and I say it only half jokingly, is when Americans are happy, we spend a lot of money. When we're depressed, we spend even more money. And again, the baby boomers are sitting on a ton of net worth. Some of it is going to start trickling down to younger generations. On the stock market side, you asked me what I'm looking for, and clearly I'm looking for analysts to remain optimistic on earnings. If companies start coming back to them and saying, your numbers are way too high, and they start lowering their numbers, that'll be kind of the first wave of indication that things are really starting to go badly to the extent where they're affecting earnings. I'm looking at sentiment indicators, and recently sentiment indicators have been so bearish that they're bullish.
Contrary.
From a contrarian perspective, there's something called the Investors Intelligence Bull-Bear ratio. I mean, that thing's down to 0.8, and we're talking about mid-March. It's down to 0.8. During the previous bear market, the low was 0.6, so we're down to 0.8. And so sentiment is extremely bearish, which, again, from a contrarian perspective, is actually pretty bullish, because it suggests that everybody's kind of sold out and everybody's expecting things to go badly, and they get suddenly surprised when things don't go so badly. Valuation 2020 of hindsight clearly was stretched. Warren Buffett probably looked at his famous Warren Buffett ratio, which is the stock prices to sales ratio, and that was at an all-time record high. And so he's been selling and raising some cash.
Yeah.
Some cash. Yeah. But he'll be coming in and buying some things because of the opportunities being created. But he's probably like the rest of us, kind of scratching at his head about where Trump 2.0 goes. And once we get a little bit more clarity on that, and that could be by the summer, I think the market could start to improve, assuming the clarity on balance shows that the worst of the uncertainty is behind us and the worst of the risk is behind us, and that we have settled or are settling some of these tariff issues in a good way.
One investment for a long-term diversified portfolio, what would you advise all of us to own some of?
Well, give me two. I mean, I think the S&P 500 companies have gotten cheaper, especially the Magnificent Seven have gotten cheaper, but I really like the S&P 493, which you obviously will own if you own the S&P 500, because I think they are going to be getting the benefits of all the technological innovations that are occurring, that are coming into place, that can immediately increase productivity. But I'd like to add another asset category that I've never recommended before, because I don't really spend any time on gold. I'm an old-fashioned strategist. I need earnings, income, coupons. Gold doesn't have any of that. I've heard that a lot of central banks in countries that don't like us, like China, Russia, Iran, and Venezuela, have decided ever since we froze the assets of the Russians when they invaded the Ukraine that maybe that they'd be better off buying more gold. So I'm just going to ride that. I think gold continues to go up.
It's at all-time records right now in current dollars.
I've been pushing it since it crossed 2,000, looked like a breakout on the charts. And so far so good, and it's been remarkably calm on the way up.
How are you participating in gold?
Personally, GLD, the ETF that actually presumably owns the gold. I hope they do. I hope it's.
A lot of people would be very surprised if they don't, but absolutely, that's the kind of the granddaddy of them all. Ed Yardeni, great to see you again, and we'll talk to you again soon.
Absolutely.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is protect yourself from market madness. As Benjamin Graham wrote in his classic, The Intelligent Investor, the investor's chief problem and even his worst enemy is likely to be himself. Graham talked about independence of thought and action as the basic advantage of the intelligent investor. Unlike professional investors, individuals are not under pressure to outperform peers or the markets. Our time frame is infinite. We don't have to justify our investments. We can buy when Mr. Market is miserable and sell when he is euphoric. Like the Greek myths of sirens luring sailors to their death with their enchanting songs, the market's lure is powerful. Do whatever you can to block out the noise. Well, next week in Ed Yardeni Part 2, how the economy, markets, and investing have changed over the decades and what it now takes to be a successful investor. In this week's extra feature, I asked Ed how he blocks out the market's noise. His answer might surprise you. Please follow us on Facebook, X, and our YouTube channel. Thank you for joining us. I hope you have a relaxing weekend and can make the week ahead a healthy, profitable, and productive one.